Hey everyone, it's Imran back with another macro option spotlight. All right, big day yesterday, obviously, FOMC. Market got its hawkish pause that was being anticipated as the FOMC held rates unchanged, but they did signal that more hikes were coming, certainly likely in July, and no cuts coming this year is pretty much seems to be what the dots are reflecting. The July FOMC, the probability of a 25 basis point hike has gone up to about 70% now. If we look at the dot plot, here you can see the move in the dot plot from March over to June. The median dots for this year, you can see they've kind of come up by about 50 basis points. So obviously the axis has gone up. We've got 7% up here versus 6% last time. And in general, we had 12 people thinking that rates would be at 5 to 5.25 3 months ago, and that's dropped from 12 to only 2 people now. So definitely a hawkish revision from all the Fed members. Now, the fact that the long end hasn't really moved, you can see in the long run, the median is still at 2.5% here, right? So that's being reflected by the fact that this yield curve has once again flattened and gone to minus 92 basis points. Okay, so the long end's not moving, and we saw that like 2-year rates moved higher, 30-year rates didn't budge, and so that's kind of on the back of what we're seeing on the dots, right? So it's being reflected in the inversion of the yield curve. And remember, the last time the yield curve was near minus 100, that's what broke the regional banking system. Okay, well, that certainly played a part in that, right? So do we start as the inversion of the curve has gone from like 30, 40 negative back to 90 negative and heading back to 100 basis points, does that mean this bank walk that Jim Bianco talks about turns into a jog and then maybe a run? You know, is it a case of more problems for the banks, which is then going to filter through to more problems for the economy, right? So that this is the concern. Now, the recession scenario, according to the Fed members as well, is getting taken off the table. So their GDP projections have moved. There were more people calling for negative GDP, not so much anymore. And then apparently hedge funds who have been playing that recession scenario via rate cut bets in the SOFR market. Remember, that's replaced the LIBOR market. They've been stopping out, right? So you've seen the move in rates. And, we think that's interesting because whilst people are stopping out of recession bets there, the long end of the yield curve, i.e. the bond market, actually ended with yields lower on the day. So we saw TLT was higher, even 10-year yields barely budged. And that suggests to us that the bond market has got other ideas about recession probabilities relative to what the front end is doing. All right, so a lot of mixed messages really in what the rates market is doing, right? Okay, moving on to our dashboard. So stocks obviously were pretty choppy as they digested the FOMC and the press conference. So whilst we held rates unchanged and the dot plot went higher, so it was at the margin hawkish and stock did initially sell off on that, we then saw Powell in the press conference distance himself from those higher dots and say that they were not a plan, they're not a decision, we're still going to be meeting to meeting, data dependent, etc. So the market liked that messaging and recovered again. So net, we didn't really go very far. And we saw the S&P pretty unchanged on the day. And actually NASDAQ still finished higher, although Russell did pull back 1%. So that's kind of what we saw. Now, overnight, we are slipping a bit lower again, about 0.5%, nothing too dramatic. The ECB and Bank of Japan are up next, with and expectations from them seem to be more on the dovish side, given that recent economic data has shown weakness. Commodities have been retreating as well. Overnight, we had Chinese activity data come in weaker, and the PBOC did cut their 1-year rate by 10 basis points, right? So these are the things that are pushing things around overnight. The dollar, whilst it had sold off, had a little bit of a bounce, still hanging around 103 on DXY. As I said, yields in the long end were actually slightly lower, TLT hanging in there, and actually small bouncing. And all sectors were lower, but pretty much 1%, 0.5% to 1% across the board. Nothing too dramatic there. Looking at vols did drift a bit lower, but nothing crazy. Nikkei vols were actually up because Nikkei continues to charge to the upside. But we chopped around and ended unchanged. So no major surprise that equity vols deciding to drift lower. VIX had it heading back to 14. And we have got obviously the usual month. As we approach OPEX this Friday, you tend to get systematic overwriting flows that keep a bit of pressure on vol. So it makes sense that vol would kind of knee jerk a little bit lower as we head into Friday. Commodity vols also softer across most names except for uranium, which was a little bit bid. We've got gold vol back to 12 there, which is looking quite low. Bond vols also lower. As the positive carry on TLT has kind of got squeezed out now, back to pretty neutral. Although HYG still only realizing 5.5, so that's still got some positive in there. But things can change pretty quickly if that decides to have a big move one day. Sector vols also, finding some stability. Healthcare catching a little bit of a bid there. ARC still showing massive carry, positive 51%, as realized is about half of what implied still is on ARC. And that's the highest positive carry across our dashboard, basically. All right. What else? So I'm looking at gold right now. So if you look at gold, the macro drivers that tend to feed into what gold wants to do are real yields and the dollar. And it kind of depends on what season you're in as to what's in the driving seat, right? So it's a bit of a moving target as to which macro factor is the most dominant. But we can see that, whilst they all move the way they kind of should have done from March last year, where you had this move up in real yields, you had a move up in the dollar, and you had a move down in gold, right? Because this is gold inverted. So gold goes down when the dollar rises and when real yields rise. So that was the behavior we saw from March last year up to sort of October last year. And then since then, you can see real yields, which is the green line, went into a bit of a range trading mode, okay? So real yields kind of went between 120 and 160, and they've traded there, ever since. But what did we see in the dollar? We saw the dollar have a pretty dramatic repricing lower, DXY back down to 103, and that was good for gold, and we saw gold rally, okay? So gold is the orange line, and gold going this way, it means gold rallying, and it went from kind of 150 on GLD to as high as like 190. Pretty big move. But obviously we've seen gold now start to correct, right? Now you can see the dollar hasn't done too much. So whilst the dollar did bounce, it started to fade again. But real yields have kind of pushed back up towards the top of their range, okay? And we see nominal yields have pushed higher, whilst inflation data is actually cooling, right? So inflation break-evens have stayed unchanged. Nominal yields have gone up, and that is essentially a real yields going higher, okay? Now, if we continue to see nominal yields break higher, because we're going to get all this bond issuance that we're talking about, and inflation break-evens remain stable, then you're going to see the top of this range in real yields break, and real yields could go at 2%, right? If that happens, and the fact that it looks like the dollar is stabilizing, finding a bit of a base, because we've got a Fed that's talking more and more hawkishly, those factors may not be good for gold, basically. Okay, you've got CFTC futures position in gold has also fallen, but is higher than it was at the start of the year still. So there's maybe still some more positioning that could be flushed out. So we think gold is susceptible to a breakdown here based on the idea that real yields look set like they might break to the upside. Okay, and we're not sure that the gold volatility surface is reflecting the risk of a material breakdown in gold. Okay, if you look at our strategy compass, obviously because gold has traded down and is kind of closer to the lower Bollinger here, our strategy compass is always going to say buy calls because vols are cheap, spot is at the lower end of the range, and it would say buy calls. Now, if you want to play the bullish angle and you're not already long gold, then yes, buying calls on gold, this is a relatively good time to do that. I've already got some gold in the long-term portfolio. If anything, I'm more concerned that gold has like a 10% sell-off that no one's really expecting. And so whilst I don't want to buy outright puts here and chase the market lower at the bottom end of the range, I am very aware of the fact that this support level, if broken, can open up a reasonably big slide to that next big support level in the mid 160s on GLD, which is like, approximately 10% lower. So that's for me the thing I want to look to hedge. So I look for ways to get exposure to that crash scenario, not because I want it to happen, but if in case it does happen, I want some money coming my way. All right, that's it for today. Thanks for listening. Catch you all tomorrow. Cheers.